Good afternoon, everyone. It's great to be here. Wonderful to be out and wonderful to be visiting Sydney. Unfortunately, I'm having to follow Albert Einstein, so bear with me. I'm going to talk to you about what we do at Axiom. It's really about the road. It's about the journey, as Connor said. And that, I think, is really critical to ESG. And I'm going to give you a couple of slides to show you why I think this is important. Let's kick it off with the 4 Ds. We're all thinking about markets. We're all wondering where things are going in the next while, months, quarters. And for us at Axiom, we distill our philosophy down to this journey that is driven by the 4 Ds. The 4 Ds stand for demographics, debt. Keep those in one category. And then deglobalization and disruption. It's really key. Nothing stands still. And these 4 Ds are driving what we do and driving the investment universe. To begin with, the first 2 Ds, demographics and debt. Unfortunately for us, this is the friction in our world. They're here to stay. I think, as we all know, demographics are predetermined. We know how many 21-year-olds they're going to be in 20 years because of the number of 1-year-olds that are here today. So unfortunately, we're in a situation where all our investing and capital flows are being governed by a world that's aging. Sadly, by 2050, between 1/3 of the world's population will be over the age of 65. And the only growth area, both in developed and emerging markets, will be Africa. That is the world we live in. In addition to that, we're clearly now in a world where we have built up crazy amounts of debt. The world right now has about 125% debt to GDP. That, as you can see on this slide, is really higher than it's been other than in the post-World War periods. So when you combine this adverse demographic situation and a disproportionate amount of debt, we really have a dearth of growth. So when we embrace change, embrace ESG investing, we're aware that the problem is there is no cadence, there is no wind at your back. However, we have 2 further Ds to save us. The first one is deglobalization. We're all aware that after World War II, the world became disproportionately globalized. Trade became 60+% of global GDP. However, as we read in the papers, as we notice in all publications and in all the news today, that has changed. The world is deglobalizing. And this is where we see opportunity. Broadly speaking, we all used to focus on just-in-time supply chains. However, today, my view is we need to have a just-in-case supply chain. We're dealing with a world where things need to be close. Countries are very focused on self-preservation, on controlling energy, food, their needs, and this really provides the opportunity and the catalyst in a socially conscious, what we call capitalist ESG, to provide drivers for capital spending, local employment, and will really act as a tailwind amidst the latter 2 Ds. And I'll show you how we can embrace this and embrace this change as a helpful and propulsive event in our investing. The final D is disruption. We clearly live in a world where disruption is accelerating. We're all aware that technologies like the telephone, the landline, took 60 years to penetrate between 10% and 99% of people's homes. However, in the last cycle, the internet took between 6 and 12 years to penetrate everyone's home. So for us, if we can embrace these disruptive changes, if we can embrace disruptive technology, it will help offset the first 2 Ds and will allow us to find clean cadence and propulsion for our investments. Here is my final slide before I transition onto our ESG outlook and how we embrace change there. This is really distills down, sadly, how public markets are for us and for myself as a growth investor. When I began in this industry, you could see on the left side of the slide, about 50% of companies were able to generate high growth, namely revenue growth in the teens. However, roll forward to to 2020 or 2021, the blue line shows you here that sadly, only 15% of companies are able to generate over 8% of growth in the public markets in terms of sales. That contrasts against 50+% of companies that are anemically plodding on at about under 4% growth. That really sets the environment for how, as at Axiom, we can embrace positive change that can be helpful and can enhance returns and can be very helpful for us finding exciting, clean, and progressive companies for our portfolios. And the next question that you're going to ask is, how do we align this positive change with ESG? And it really comes down to us being able to embrace, it's all about the journey. It's all where you begin, and so long as one's moving in a positive and in a progressive direction, it's incrementally helpful to create returns for investors. If we take a look here, our research department did a bunch of research on the outperformance of ESG factors against the outperformance of quality factors in the stock market. So quality factors, the gray line here, are really represented by companies that have low debt to equity, high ROA, and low volatility or low beta in their stock price. And this chart, as you can see, for approximately 5-6 years, really shows you that the quality factor has underperformed the ESG factor, the high-scoring ESG stocks as determined by Morningstar and MSCI. More importantly, as I said, it's all about change and it's all about the journey. And I think this slide really captures the opportunity. What this is it is the change in ESG alignment is more important than where one begins. So the bar on the left, really 5% outperformance, articulates that a company that can move from an ESG laggard to an ESG leader over the last 2 years, this data series shows, disproportionately outperforms the sustained leader and obviously the leader to laggard. And that, at the crux, is really how we at Axiom address ESG and how we generate disproportionate alpha by looking for change. In addition, clearly, ESG embraces 4 broad areas. The environment is critical to us all. Obviously, to people in Australia, it is imperative. We have some ESG leaders in the Netherlands that we invest for. And we begin at a very good point as being a growth manager, as focusing on stocks that really focus mainly on human capital. There are service businesses. And our footprint in terms of carbon is about 1/10 of the index. So we're starting at a very good point. However, we find the other 2 factors, the S and the G, to be notable and salient. Sadly, those carbon factors are very slow to progress. Things can improve, but it takes an awful long time. However, if we take a look, first of all, on the left, at the social factors, what we can see, and this data is particularly for the S&P 500, is that an improvement in social criteria has a disproportionate effect on creating outperformance, particularly in the United States. In addition, and I'll address that a little later, but it particularly is relevant in the growth sphere to businesses that have high levels of social capital, that are mainly low asset businesses, where they're people that ride up and down or work at home every day, are the impactors of returns and growth. On the other hand, in the non-US markets, here we can take a look at the governance factors. And clearly what you note, to some degree, because it's all about the journey, as I said, they're beginning at a less favorable place. You can clearly see that for companies domiciled in Europe and in Asia, improvements in governance over the medium term, over the last 5 years, disproportionately impact and create alpha for share price performance. bringing this all together, you can see these charts that really depict in the US the gray line and how much more material and smoother incremental alpha can be created by the social factors, particularly in the US, and then conversely, outside of the US, how governance has disproportionately added incremental returns over the past 5 years. At Axiom, we believe in a very proactive engagement in our companies. This, we believe, is helpful as we are embracing change. So as a group, we have 150 engagements with managements per year. These fall in many categories. We obviously are engaged and subscribe to services like ISS, where we're very active in proxy voting. But that's just the point of departure. Really, for us, things like resolution letters that we do either on our own or that we do in collaboration with organizations like Climate 100, Ceres, and PRI are critical and really helpful to add and improve the stocks ratings that we hold within our portfolios. It begins with a defined strategy. We really are sure to articulate what we're looking for. We look for flags in the overall ESG scores, and then escalate and appropriately address those where we can make impact. And I'll give you 1 or 2 examples how we've been able to do this and how that has really had material investment impact. If we take a look here, I'll begin with Servicenow. So this is a software company that I think we all know of. They're leading in what they do. And this was a business that we noticed in the MSCI scores that they were not particularly proactive in training parts of their workforce, in reviewing and enhancing the environments that those workers could progress in their careers. And we flagged this to the management and formalized an approach with a 14B letter to the management and addressed and discussed this, and they set up training programs, resources, educational support for their employees, and that really created dramatic improvement in employee satisfaction. But more important, or equally important, that was recognized by the rating agencies, and within a quarter or 2 of us engaging in this, the ranking at MSCI improved from a single A to a double A. So that is an example how a small boutique manager like ourselves can be proactive and can get significant progress for the alignment and the governance of a company. So, similarly, 2 other examples. Adyen, a payments company in Europe. Here we really had intensive dialogue with the management on many topics, including board oversight, data security, some whistleblower policies, and without taking a vote, without having to engage lawyers, we were able to achieve an upgrade in the company, and this company has become a leader in the payment space and actually has a banking license and has been very forward-looking in terms of their ESG subsequent to some of our discussions. And then finally, Nestle. Everybody knows Nestle is a leading global company in the consumer space. We noticed recently when we embraced and began to buy Nestle that there were, and through dialogue with Adam and his team, there were factual defects in the rating agencies' understanding of Nestle. They still believed Nestle owned an alcohol business, which they'd sold. So simple, detailed, and diligent approach to the data and the ratings has allowed us to incrementally add value for our investors. With that, I'm going to leave it and transition back to Connor.